Already ready?
Already started the class. All right. Everybody except Ian has logged in. Hopefully he'll be here anytime. So we're taking a look at different exercises for calculating things related to pensions. So I want to bring your attention to the next exercise. So let me share that on the screen. Okay, so in this exercise, it's calculating the PBO, pension benefit obligation. And to refresh your memory about what we've been talking about, that's the estimated present value of the amount that the company already owes the employees to pay them their pensions in the future based on what they've already earned. And it's at the present value because they've got time to invest money and make it grow. And so the interest that could grow on the investment doesn't need to be included in the liability. If they invest enough now to take care of the amount, then they wouldn't have to pay for that interest. It says on January 1st, RaveTech's PBO was $30 million. During the year, pension benefits paid by the trustee were $4 million. Service cost for the year was $12 million. Okay, so pension benefits paid by the trustee, $4 million. That means that they liquidated plan assets to get cash and then paid cash to retirees for $4 million. So they're paying down the debt owed to the retirees. Service cost for the year is $12 million. That's how much they earned during the year at the present value. Fair market value of the pension plan assets increased during the year by $6 million as had been projected. At the end of 2021, there were no pension-related OCI to amortize. The actuary's discount rate was 10%. So we'll calculate the ending balance of the PBO. So at the beginning of the year, which you see here, which was the end of last year, the amount of pension benefits that they owed was $30 million. So we would first add the service cost, the pension that they earned during the year, 12 million. Discount rate is 10%, so 10% times the beginning balance is 3 million, and that would be added to the liability. Present values grow if liabilities are not paid for. There is no prior service costs, so we don't add that. No actuarial gain or loss. And what about this 6 million? That's not relevant to this calculation. If the plan assets grow, it doesn't change how much they owe. So we could think of it as this way. Let me stop the share here. Go to this whiteboard. Okay, so what they owe on a better way to do this. Okay, so what they owe, if they compare the pension plan assets to the PBO. So pension plan assets is what's been invested on their behalf. PBO is what they owe. So if more has been invested than they owe, it's a net asset on the company's financial statements. And I think I need to go back and refresh your memory on something. Who owns the pension plan assets? Can't use the chat on this because I can't see it. So if you're going to answer, you'd have to turn on your mic, on your audio. Who owns the pension plan assets?
The employees.
The employees. Okay, so that's what they have in the plan to finance their pension. PBO is what the employer owes. So if there's more invested for the employees than they owe, then they've prepaid and have a net asset. But if the pension plan assets are less than the PBO, then it's a net liability. They have not invested enough in the plan to cover what they owe. So now let's go back to the PowerPoint. And so this ending balance right here is not the net amount that goes in the company's financial statements, but so what they'd put in the financial statements would be the plan assets deducted from that. So they owe them 41 million. This is a question about whether or not they have enough invested to pay for that or not. If they don't, then they have to show the difference as a liability. So this 41 is not a number that goes in the financial statements, but it is a number they need to calculate in order to know what to put in the financial statements. So they paid benefits, that means they owe less. But this part right here about the pension plan assets, that is separate from how much they owe. Whatever amount you owe is different from whatever amount you've saved up to pay for it, if that makes sense. Okay, let's go to the next one, calculating pension expense. So in this exercise, it says the service cost was 112 million, beginning PBO 850, interest rate 6%, beginning fair market value plan assets 900, net loss AOCI amortization 1 million, prior service cost amortization 8 million, expected return on plan assets 10%, actual return on plan assets 11%. They have given you here information that you don't need to solve the problem. And some students think of that as being sly or tricky, but it's actually kind of realistic because in real life, you have to know which information to pick that's relevant. So calculate the pension expense, service cost. The employees earned $112 million in pensions. That's discounted to the present value by the actuary. The interest cost is 6% interest rate times the beginning PBO, 850. 6% times 850 gives us 51 million. Actual return on plan assets, the beginning balance of the 900 million, let me back up. Beginning balance of the plan assets was 900 million. It increased by 11%. But what we're doing here is the expected return, because as we talked about in class on Wednesday, it's the expected return that they need to know in order to determine how much to budget for their pensions. So the return on plan assets is the expected return, not the actual. 10% times 900 million is $90 million. And if the plan assets grow, that is money that won't have to come from the employer because the investments earned the amount to pay for the pension. And so that makes it $90 million cheaper for the employer. Amortized prior service cost is given. And then net loss AOCI amortization, it doesn't tell us whether it was a PBO or plan asset, amortized gain or loss. They gave us the total, but not which of the two components. Add them together, we get total pension expense of $82 million. Okay, questions, comments on what we've covered so far? Then let's go to next exercise. Calculating plan assets. Plan assets beginning balance is 600 million. Expected return 10%, actual 48 million. Contributions investments made 100 million. Benefits paid 11 million. Pension expense service costs 72 million. The components that change plan assets are on the left. We can then calculate the answer by filling in the numerical amounts on the right. So plan asset beginning balance is 600 million. Then actual return on plan assets was 48 million. The expected return was 600 million, beginning balance times 10%, so that's 60. If the actual was 48, that means the unexpected return on plan assets was 12 million. So comparing the 60 and the 48, the 60 means that in the long run, stock market investments earn an average return of 10%. Individual years are unlikely to be exactly 10%, but that's the long run average. So this year it was 12 million below the average they would have expected because it earned 48 million, when on average the amount it would have earned this year would have been 60. So 60 is the amount they need to use for budgeting how much to invest. And then the 12 million would go into AOCI. Some years this would be positive, some years it would be negative. Usually they cancel each other out. Cash contributions, that was money that the employer and possibly employees put into the plan to get invested. So that increased plan assets by 100 million. And then they paid 11 million in benefits. So at the end of the year, the plan had 737 million. Questions on that? Then let's go to pension spreadsheets. Pension spreadsheets show all of the information for a company's defined benefit pension plan for 1 year. Study the examples in the chapter and the ones solved on the following slides. The 6 center columns, let me flip down so you can see the center columns. 1, 2, 3, 4, 5, 6 center columns, a right column of numbers, a left column of labels. Show accounts that are recorded in the company's accounts. One of which is cash, but we're not interested in the beginning or ending balances of cash for this purpose because the pension plan is not the only thing that affects cash. For this purpose, we're just interested in the changes in cash that result from pension transactions. The net pension liability or asset is reported on the balance sheet. So let me show you a completed one here. And this right-hand column, the reported net pension liability or asset, that's what they show on their own company balance sheet. So notice at the beginning of the year, the actuary estimated that they owed $800 million on the plan, and there were $600 million invested in the pension plans. So they had an unfunded pension liability of $200 million. At the end of the year, the PBO was 862. Plan assets had grown to 660, not quite enough to keep up with the increased liability. So the unfunded liability increased from 200 million at the beginning of the year to 202 at the end of the year. So that net pension liability or asset is reported in the balance sheet. I usually see assets, I mean liabilities. I can't remember a company's balance sheet where I've ever seen it as an asset. Pension spreadsheet exercise. The beginning balances of PBO were 800 million, plan assets 600 million, prior service cost 114 million, AOCI net gain or loss 80 million, net pension liability 200 million, average remaining service life is 20 years, actuary's discount rate is 5%. So the interest cost is 800 PBO times 5% is 40. Prior service cost was created 2 years ago. The original balance was 120. The year's service cost 84. The expected return on assets was 48 million. Also, the ending balance of the PBO was 862, and prior service costs ending balance was 108 million. In real life, you'd be needing an actuary to get those numbers for you. Additionally, the cash funding made into the plan was 68 million. There is an actuarial gain on the PBO of 12 million and an unexpected loss on plan assets of $6 million. So we will plug these numbers into the spreadsheet on the following slide, then continue. The blue cells indicate given data. In the second spreadsheet slide, we'll move the given information across each row into any column that is appropriate and then color those cells purple. So here's the information that they gave us to solve the problem, to complete the spreadsheet. So beginning balances were given. PBO 800 million, plan assets 600 million, prior service cost 114, accumulated loss 80 million. And they didn't tell us this, but the pension expense account at the beginning of the year would be closed because all expenses were closed at the end of the last fiscal year. And so it starts off always with a balance of 0. Cash, we don't know the beginning or ending balances because cash is not the only, pensions are not the only thing that cash is collected for or paid for. Net liability, 200 million. Then we were told by the actuary that the service cost for the year was 84 million. So that's pension expense. The interest cost was 40 million. We were told that the expected return was 48 million. So that decreases pension expense by 48 million. Loss on assets during the year, 6 million. That's the unexpected loss, so that goes to AOCI. Gain on the PBO, 12 million. Notice here that they've set this, since it's a liability, as a negative number. And so the gain on the PBO is a positive 12. What that means is that something by the actuary that the actuary is using to make the calculations changed. And the actuary said, because of this changed assumption, you will owe $12 million less than we had previously calculated. So that goes into AOCI net gain column. Prior service cost, there's no new prior service cost, so that doesn't change the PBO. they already had 114 million that's being amortized, and then the cash funding was given. The company invested $68 million of cash into the plan, and we're given the ending balance of the PBO is 862, and the ending balance of the prior service cost is 108. So those are the numbers that were given. And so from that, we can use it like a puzzle to solve for the missing pieces. Before we do, oh, Ian made it. Somehow I accidentally first sent it to just Thomas. He doesn't need to know. I need to know. Okay, no questions about that. Then let's take a look at the spreadsheet. And see what we can do with those numbers. Okay, so some of the numbers that we're given now, we can extend into blank cells on the spreadsheet. If pension expense was 84 million, that means they owe 84 million because the employees earned it. And then this net liability would grow by 84 million. If interest cost was 40 million, that means also their pension expense would increase by a cost of 40 million, and their liability increases by 40 million. If the expected return on the plan assets decreased pension expense by 48 million, then it would increase plan assets by 48 million and decrease their liability by 48 million, their net liability. If the AOCI gain on the, no, it was a loss on the plan assets. So that decreases plan assets by 6. In other words, they actually earned 42. But for budgeting purposes, it should have been 48. And so now that we've put in both these numbers, it will show the correct change in plan assets, but they have to be treated separately because the 48 is the amount to use for budgeting long-term pension expense, not the unexpected amount of 6. Then if they funded cash of 68 million, that means that it went into the plan assets and increased them by 68 million. Questions about that? Now, in the third iteration of the spreadsheet, we can make the following calculations. The ending balance of the PBO is 862 million. All numbers are in the column except for the benefits paid. So you can set up a column or an algebra equation, 800 plus 84 plus 40 plus, those are negative, plus 12 plus x equals negative 862. So by algebraic manipulation, we would find x to be 50. Let's go back and take a look at that. In other words, in the PBO column, we have every number we should have except down here at the bottom for benefits paid. So what number would have to go there in order for this column to end up with the correct balance? Now, this is doing it as a puzzle, not in real life, because in real life, the pension administrator would know exactly how much benefits were paid and would have told that to the employer, who isn't going to have to do a calculation to figure it out. Second, according to the corridor system, the AOCI will need to be amortized only when it exceeds 10% of the PBO. It doesn't in this case, so it won't be amortized. Let's go back and take a look here. What would we get if we added up this column? We get 74 million. Now, remember I was saying that these AOCI gains and losses should offset each other. The gains should balance off some of the losses, and in the long run, they should be canceling each other out for the most part. FASB said if that doesn't happen and the number in AOCI gets too big, then you have to amortize it and take dollars out of AOCI and record them as a loss or gain on the income statement. And FASB said, how do you know if it's too big? If it's 10% or more of the PBO. So the PBO is 862 million. 10% of that would be 86.2 million. This $74 million is smaller than that, so they don't need to amortize it. Prior service cost, originally 120 million, is amortized over 20 years. The average remaining service life, so the amount is $6. The ending balance is therefore 108. Plan assets add up to an ending balance of 662. Pension expense for the year adds up to 82 million. The ending balance of the net pension liability is 202 million. These final changes are shown in a bright pink color. Here we go. Blue, purple, we had those already. So we had everything in the PBO column except the benefits paid. So it must have been 50 million in order to end up with 862 at the end. So that means that 50 million was taken out of the plan assets. 600 plus 48 minus 6 plus 68 minus 50 gives us an ending balance of 660. We are given the ending balance of the prior service cost. And so the amount amortized is 6 million. That goes out of AOCI and into pension expense. So we add that to pension expense. The AOCI of 74 is not large enough to amortize. So these two amounts are zero, amortized net gain or loss. Add up the numbers in the pension expense column, we get 82. Add across, or 862 minus 660 is 202, and add vertically to confirm it, and you come up with an ending net pension liability of $202 million. Questions, comments on that? Okay, then let's take a look at the next slide. Pensions and IFRS. And IFRS for pensions are very similar to USA GAAP, but there's a few differences. IFRS refers to the gains and losses in defined benefit plans as remeasurement gains and losses. IFRS requires the actuary to use the same interest rate for the pension plan assets as is used for the PBO, which IFRS calls the defined benefit obligation, DBO. An entry is made increasing both the plan assets and the DBO for interest, and then a net interest cost or gain is recorded for the difference. I'm not sure why they said it had to be the same interest rate, because in the United States, you would know 10% is the long-term average rate of return on the stock market. And so it makes sense to use that for plan assets, while interest rates vary from company to company depending on their levels of risk and how the economy is doing. The second difference is that actuarial gains and losses, once recorded as part of OCI, are not amortized to the income statement. Instead, they remain on the balance sheet apparently forever. Prior service cost is expensed immediately under IFRS. It does not pass through OCI. In IFRS, the following are reported as separate components in the financial statements: service cost, net interest income, remeasurement gain. So remeasurement gain is in the statement of comprehensive income. It bypasses the income statement. In the income statement, they pull out the interest income and report it separately from the service cost. In USA GAAP, they're combined in one account, pension expense. There's a more detailed discussion of this in the textbook. So the next topic is other post-retirement benefits, but I think we'll save that until Monday. A lot of you have a lot of homework that you need to catch up on. And so, any questions or comments on these exercises for the pension expense, for the calculation of the plan assets, PBO? There are a lot of short, brief exercises that have been added to your assignment on those topics. If there's no questions, then take care, listen to what they're telling you about how to keep safe and healthy. And I will see you again on Monday. Talk to you then.